Hello friends, Marv Eisen here from Timeless Dollar Trading Academy. It's President's Day weekend and you're looking at my E-mini chart back at February 1st. And as you know, I've always put Taylor's trading zone on my chart together with the previous day's close and the stochastics. I don't put anything else in my chart. My chart is pretty clean and I concentrate on the prices while I'm trading. But I always use numbers as my main point when I trade to consider where the market is going to go. Now, nobody knows where the market is going to go, except the numbers do provide a clue. So how do I get these numbers? Well, first of all, I use the Taylor trading calculator to calculate the trading zone support and resistance for the following day. And you're looking at my Taylor calculator. It looks complicated, but it's really not. The only thing that has to be entered is the date in the left column, and four numbers to the right of that. The days open, high, low, and close. And all the other numbers are calculated out automatically. And so the numbers that I'm concerned with are the day's close and the trading zone for the following day, resistance and support. So those are the numbers that I first use to place on my chart in preparation for trading. And so I've established my numbers. And I'm going to use this chart from February 1st, as an example, and then I'm going to take you through the rest of the month. Now, the trading zone, I always say the market has targets. The market has targets. It knows where it's going to go. So the first target, of course, is the previous day's close, which is the horizontal line that I place on my chart. The other two targets, actually there are three, is the trading zone support, the lower limit of the trading zone that I got from the calculator, and the trading zone resistance, the upper limit that I got from the calculator. And of course, the range between them. And the range is just as important as the support and resistance. And so on February 1st, prices traded within the trading zone didn't quite hit the previous day's close, didn't hit support, hit resistance several times. Now, keep that in mind. I'm going to take you through the rest of the month of February. We have the trading zone support, previous day's close, and resistance. Now, these are the target numbers. The other question of using the targets is, are they going to get to these targets? And if so, when? And for that, we use the stochastics plus the 6 trade setups that I teach in my course: gap, support and resistance, trend, time and price, momentum, and candlestick, GST, TMC. So we have the gap, we have the Taylor support, we have the Taylor resistance, and we have the when it's going to hit these targets, if it does, by using the stochastics. And I use a relatively fast stochastic 733. Now, again, this is February 1st. And again, the market did not hit the Taylor support, it did not hit the gap, did hit the resistance. Now here is February 2nd. All right, didn't trade within the trading zone, did hit the gap, did hit the resistance. Going forward to the Monday the 5th, and then Tuesday the 6th, and then Wednesday the 7th, Thursday the 8th, prices traded almost exclusively near the previous day's close, the equilibrium line. Friday the 9th, Monday the 12th, Tuesday we had an upset with the market, call it a black swan event, because an inflation number came out that was higher than the forecast. So that's what caused this 8:30 drop down, which of course recovered during the rest of the week. Wednesday the 14th, just bear with me, I want to make a point. Thursday the 15th, Friday the 16th. And so what's the point, Marv? Well, here's the point. As I said, I trade by the numbers. And what are those numbers? They're the gap, they're the Taylor support, they're the Taylor resistance, and they're the Taylor range. In these 12 trading days, from February 1st to Friday, February 16th, the market hit the gap 9 times. The market hit the Taylor resistance target 8 times. And the market hit the support, the Taylor support, only 2 times. The reason being, the market is trending upwards. So when the market is trending upwards, we're going to hit the Taylor upper limit far more so than when the market is trending downwards, and vice versa when the market does trend downwards. But these are the price points. These are the price targets. The market always has targets. Question is, what are the targets and when will they move to those target areas? Thanks for watching. Have a great weekend. This is Marv Eisen for Timeless Dollar Trading Academy. Trade safely, use lots of patience, and I'll see you in my next video.